Hello everyone, thank you for joining me. My name is James Smith and I'm here with Grant Patterson to run through our quarterly outlook and strategy update. Grant, thank you for joining us.
My pleasure.
We started the year with the phrase "a year of change." Could you perhaps run through some of the things that we've seen play out over the first quarter of this year?
Yes, well, we have actually seen quite a bit of change in the first quarter. It's been quite volatile. So equity markets had quite a reasonable correction in February. The Dow Jones is down around about 9% from its high. Australia's down about 5%, but we've also seen a lot of volatility on the way through. So markets are starting to question about the outlook for inflation, higher interest rates and how that may impact on asset values.
And with the increased volatility, we've also started to see, after several years of synchronised growth, some signs of slowdown in some pockets of the world. If you could perhaps just run through that.
Yes, well, global growth has been quite strong throughout end of last year and is still quite strong right across the globe. But we're starting to see some of the forward indicators softening, particularly just in the velocity of the growth. So the question's starting to come up now whether that's as good as it gets in regards to global growth, and are we likely to start seeing a bit of a slowdown from those sort of levels? And that's creating and adding to some of the volatility that we're seeing in asset markets.
And the increased tension. And if we were run through our views on asset classes and go for a bit of a walk through our views, perhaps start with Australian equities.
Yeah, well, we've said for some time that we thought that equity markets around the globe, including Australia, were vulnerable to a correction. Valuations were quite high. We prefer international equities to Australian equities, and Australian equities have lagged for some time. But now, after the recent correction and good earnings growth, multiples don't look, forward multiples anyway, don't look as stretched as what they were before. The Australian market, it's hard to find value though. Banks still being a large part of the market and really not going to be seeing much growth over the coming 12 months, let alone the impact of the inquiry. So bit better value, still cautious on equities generally. On the international equities, we prefer Europe and Japan as the preferred sectors, and the US we think is going to struggle a little bit under the higher interest rate environment that they're likely to see, plus the weakening a bit in the technology stocks that have had a very big run.
And we recently adjusted our exposure to Australian REITs, real estate trusts. Could you just run us through what's happened there?
Yeah, Australian REITs performed very poorly last year and the year before, and we did reduce our holdings about a year ago because they were trading at quite high premiums to NTA, and markets were rightfully concerned about the impact of Amazon on the retail sector. So they've come back to a level now that we think look reasonable value, trading around their NTAs, giving a 6% distribution yield, some sort of inflation protection with the rental increases that come through. So we have been adding to that asset class.
And alternatives, they provided a buffer for us over the volatility, particularly in February. Just touch on that.
Yes, well, we've got the alternatives in the portfolio to try and smooth out volatility. And when we saw that big fall in February, the alternative part of the portfolio held pretty well. So the total portfolio for our model portfolio, if you like, on a balanced fund, was down around about 1.5% when the markets were down about 8.5%. So the cash weighting, which we'll get onto, and the alternatives certainly provided some cushion and protection for the portfolios.
And we have concerns, and we have for some time, about tail risks in the Australian economy. Could you just run us through some of the key concerns that we have about the Australian economy?
Well, the main issue about the Australian economy is the household debt levels, very extended, and the exposure to the housing cycle. And as we know, the housing cycle's been very, very strong. There's been a big supply of apartments coming on. We're starting to see some weakness now in house prices and pressure somewhat on the household balance sheet. And also what we're starting to see now is that funding costs for the banks are going up. So they may pass on those higher funding costs in the form of higher mortgage interest rates.
And overall, our investment stance, you would say, would be?
Still cautious. We're retaining a reasonably healthy level of cash, particularly given that we don't have any international bonds in the portfolio, government bonds in the portfolio. So we're cautious. We're keeping that cash ready to deploy in a reasonably large correction. But we still have a weighting to growth assets that are providing a reasonable yield, and portfolios are holding reasonably well despite the volatility.
Thank you. And any other updates for Providence?
James, recently we held a luncheon down in Melbourne for His Royal Highness Prince Edward on behalf of the Duke of Ed Award and the REITs Foundation, which was a great event, and we enjoyed hosting that for those two good causes. And we're delighted to announce that Bianca had a baby girl in February, Emerson, and they're both doing well.
Fantastic. Thank you, Grant, and thank you for listening, and we look forward to updating you in the next quarter.